Hello guys, welcome back to my channel. Today I'd like to discuss the subject related to the dividend stocks. Why dividends? And first of all, what are the dividends? This is the form how the company is sharing their net income or profit with the shareholders. So basically they are just paying out some cash to you, to me, to the shareholders. And why dividend stocks? I see the three main reasons for me to have them in my portfolio. The first one is very obvious, is the cash flow. So I like to see when sometimes I've got a notification from my phone saying, oh, you received some dividends from this company, such and such amount. It feels good, but the main point is that you receive cash for the asset that you own. And then this amount of money, this dividend, you can use for the reinvesting. So you can buy another stock or the same one again. So thus the compounding effect is growing even faster. And the second reason why to have dividend stocks, because these kind of assets, they behave differently than other types of stocks. Ideally, the portfolio, the balanced one portfolio should look like that it contains different types of the companies. Like I prefer to have the majority of them the growth companies, which grow at 20+% in terms of revenue and net income. And for my age, my psychological portrait, my risk tolerance, I would prefer to have the majority of it in my portfolio. Then I like to have some value stocks and the dividend ones. So, and quite often when I see the whole market going down, especially the tech companies or the index Nasdaq, majority of growth stocks are going down together with it. But the dividend stocks, they quite often work as the hedge. So in this moment, they might be all going up. So it provides and diversification and the balance for my portfolio. And I tend to have from 2 to 3 dividend stocks in my 10 to 15 stock portfolio. It depends from the time. And the third reason I like to have dividend stocks is even before I used to have such a strategy when I was researching and buying the undervalued dividend stock, and with the mental readiness to have it long term purely for the dividends, let's say 4+%, which are being paid out, let's say quarterly. And I mentally prepared to have just this tiny amount of gain, which covers inflation mostly, and that's it. But I know that there is a very high potential for the stock to recover. And when I saw the stock price moved up 20 to 30% within some short time, let's say half a year, I would fix the profit, I would sell the stock. It was a kind of premium for me, so these dividends, the premium to hold the stock until it recovers. And today, as you can see probably from this slide, I'd like to speak a little bit about one of the companies that I own in my portfolio. This is the company PepsiCo. And you can see the title from the recent news just 2 days ago was released. PepsiCo beats revenue estimates as volumes improve globally, but shares drop. So PepsiCo for me is a perfect example of the dividend company. It grows in the single digit percentage yearly. and it pays out majority of its net income in the form of dividends. And just a few days ago, there was an earnings report, and I've listened to the webcast, to the earnings call, and I've highlighted few things, and I'm going to share it with you. What were the good points? What were the bad points? But why this stock I'd like to own in my portfolio? Let me show you. So this is the chart. We are coming back to, so we can see it from 2014 more or less. Have a look. Now the stock price is at the levels of 2019 more or less. Now the company has the lowest P ratio for the last 5 years. It's around 18. If we look to the forward P ratio, price to earnings ratio, it's even less. It's around 16.5 or something. Now the stock provides 4.3% of dividend yield. And coming forward, I'd like to say that this is the record high for the company. And the company is able to pay those dividends. The payout ratio is still high. It's above 93% of the net income that they are paying to the shareholders. But it was from 2025. But if we go back, let's have a look in the earnings and revenue. Let's go back to maximum I can go back is 2019. So you can see from this point the company was increasing their net income and the revenue year after year. Yes, it was at slow pace, but still it was growing. Then let's have a look at the balance sheet. The company total equity from 2019 was going up and up all the time. So the company, the quality of it has been better and better. So looking at the balance sheet, looking at the earnings, I like to see this stock price, because for me it's very obvious that it's undervalued at the moment. And if you want to compare with the Coca-Cola company, let's do it here. So the Coca-Cola company is the major rival, and usually the stocks behave the same, and they have more or less the same quality of the business, but the stock price of Coca-Cola is an all-time high now, where the PepsiCo is still lagging. But the Coca-Cola provides, I think, 2 point something dividend yield, where the PepsiCo has 4.3. All right, let's go to the main points that I wanted to highlight from the earnings call. The main growth drivers were that the management emphasizes strong international growth as a key driver, with the international segment becoming a significant part of the company's volume and revenue. The US market, while mature, is still seen as a critical area for growth through strategic investments in affordability and portfolio transformation. Qualitative influences, rising inflation, particularly gas prices, has impacted consumer behavior in the US, affecting volume growth in certain areas. So here they are highlighting 2 points. The first of all, that they've got a major catalyst, which is the international growth, so the volume grow. And the second one, that the US market is lagging purely because of the gas prices. So now we know that whenever we've got high gas prices, like now with the conflict in the Middle East, it negatively influences the stock. These are the comments from the CEO during the earnings call. The first half reported almost 7% revenue growth, and we've grown global volumes 3% in foods and 2% in beverages. That's the fastest growth in volume since 2022. I'd like to stop even at this point. So the company highlights that the business quality has been improving for the last 4 years. So the volume is growing, but the stock price is still the same as 6 years ago or 7 years ago. But I want you to step back and take the bigger picture that a category that was negative in volume now is positive in volume. We were losing share in volume. Now we are gaining share in volume, and that is all very, very positive. In other words, they're saying that it's a turnaround story at the moment. And when I see these signals, it's a very strong and a very bullish sign for me to own the stock. So from this moment, we can expect the business performance to improve. I like seeing this one, so I know that the company is on the positive trend in terms of volumes. But they mention here, now will it change in the coming months? It all depends on the price of gas. So clearly that's something that is beyond our control. So the top management is saying basically, so we are doing our best, but now it's a macroeconomy that influences our business, and basically they are talking about the consumer confidence. As it's the company is a purely consumer related business, which depends on how the consumers feel about the economy. Are they willing to spend money into something which is not necessary, like snacks? And for me personally, it's a kind of a sign. If I see the gas prices going down, I know that okay, it's gonna influence positively for the company. So that's the only risk basically that they mentioned, which is not related to the company. Okay, now I know that it was the latest earnings report. I was happy with it because it was actually better. There were better signals than in the previous earnings reports. The company is growing, not as fast as the growth stocks, but this is how it should grow. The company has been paying dividends for I think it's a dividend king, for it was increasing dividends for more than 50 years in a row. I see that the dividends are safe. I see that the dividend yield is the highest in the recent history of the company. I see that their equity is growing. So for me, it's a very no-brainer for my dividend part of the portfolio. So I'm happy to have it. But this is not the type of stock that you would expect, I don't know, 50% plus within a year. No. For me, this is the type of stock that I can own and sleep well, and knowing that the dividend will come into my account every quarter. And there is a huge potential to grow. So this was the first stock that I wanted to share with you. And another one which was really surprise for me, just because it always has to be the growth stock, and I didn't expect to see such a transformation. First of all, let's have a look at the chart. The company name is Accenture. Let's go through the description of what actually the company is doing. Accenture is a global professional services company that helps the world's businesses, governments, and other organizations build their digital core, optimize their operations, accelerate revenue growth, and enhance citizen services, creating tangible value at speed and scale. The firm combines technology and leadership in cloud, data, and AI with industry experience, functional expertise, and global delivery capability. Look, this is where you could clearly see the trend where the company was acting as the growth company. And since that, the stock went down nearly 70%. And have a look at the PE ratio for the last 5 years. Now the PE ratio sits at roughly 11, and if we have a look at the forward one, it will be even less than that, around 10 plus. But the thing is that the company now provides with the dividend yield of 4.8% and paying out the dividends also quarterly. I've never seen such a high yield with this stock. And look, the main difference with the PepsiCo. PepsiCo was paying almost whole net income to the shareholders for the last few years, 90+%. Now, when we look at the Accenture, it pays less than half of the net income to the shareholders in form of dividends. So the dividends are more than safe. And also the company has the buyback. So it's another form how the company returns to shareholders. What I wanted to mention as well, let's have a look at the balance sheet. From 2019 till today, the total equity increased about 2.5 times. Have a look at the cash flow. The free cash flow at the moment for the 12 trailing months is around $12.5 billion with the company capitalization of 82 billion, which represents around, I don't know, 15% more or less of the free cash flow. Then let's have a look at the income statement. It's all-time growing. Yes, the pace slowed down, and this is the main risk for the company, and this is why the company is traded so low now. There are two reasons. First of all, the AI disruption. So first of all, it was one of those companies which is in the list together with the Salesforce, ServiceNow, with the Adobe. So like everyone is afraid that AI will kill the company, but I've been listening to the earnings call. This is what exactly they consider as a tailwind. Basically, they are implementing the AI into their platforms, into their business, and also they are doing acquisitions of the other businesses, and they are now into the cybersecurity. So basically, they're trying to adapt into the new reality. And so this was the one reason, the AI disruption, and the second one is that their growth rate decreased in comparison with the past. Let's have a look at the few moments that they mentioned during their earnings call. So this is what they are saying. We are pleased with our third quarter results with revenue above the midpoint of our guided range, with strong profitability and robust free cash flow. We delivered these results while continuing to invest in long-term market leadership and returning significant cash to shareholders. Based upon these results, we are on track to deliver or exceed all aspects of our guidance provided in September. So they still perform very well. They execute quite nicely, in my opinion. They delivered strong results, better than the midpoint, and also they expect to be in line or even exceed their guidance. That's a very positive sign for me. In the third quarter, we continue to accelerate our share buybacks and repurchased or redeemed 6 million shares for $1.2 billion at an average price of nearly $200 per share. So the company was ready to invest their free cash flow into their own business. And they were basically saying to people, look, even at this price, we look so good that we do the accelerated buyback. Now the market offers us a bit of discount, in my personal opinion, for around 30%. So it's the price now lower that the company was happy to pay. So they were saying we had approximately 3.2 billion of dollars of share repurchase of 30 remaining. Here they say that their EPS grew 9% in the quarter to $3.8 compared to the EPS last year. Finally, we delivered free cash flow of $3.6 billion and returned $2.2 billion to shareholders through repurchases and dividends. They are saying here that the earnings per share are growing at still it's a single digit, but very high single digit growth. So the company is still growing. They mentioned also here that they had some negative effect from the Middle East conflict. So once we see it's improving, we might assume that the company's business will also benefit from this. So the company is growing. We can see that the equity is growing. We can see that their dividends are more than safe. And don't forget that the main topic of this video was about the dividend stock. It means that we want to have the company which is likely won't cancel or decrease dividends. So these dividends are safe. They are increasing the ones, they are paying quarterly, the payout ratio is very nice, and they also buy back the shares. And I never thought I will ever compare these two stocks, PepsiCo and Accenture, purely because these companies are totally different businesses in different areas. But the only thing I compare here is the dividend section. And look, here is the dividend yield. Pepsi offers 4.3, which I'm happy with, and also Accenture provides even more. The dividend growth the PepsiCo provides is around 5% annually, and the Accenture with a 10% growth rate. Then payout ratio here it's mentioned 78% of net income is going to dividend to the shareholders, and Accenture is around 52%. For me, it's a clear winner in terms of dividends is the company Accenture, but just because I'd like to have few of the stocks in my portfolio which are paying dividends, I would be glad to have both of them. So in fact, I have the third company, which is Novo Nordisk, but I did not mention it here. I think it's enough just with two to show, just to show my way of thinking, how I choose the dividend companies. And for me, these two stocks are no-brainer, easy to have no issues with sleeping, so I can sleep well with them, and I'm happy with the dividends they provide, and I see a high potential for the stocks recovery as well. I'm pretty sure that the Pepsi will gain even the short term, and Accenture will go up together with the other SaaS related stocks. All right, guys, I would be glad to see your comments. If you own at least one of these stocks, please let me know what are your thoughts. Maybe I've missed something. Maybe you've got some insider information or something interesting to share with me, or just let's discuss. Maybe you've got the other companies, and I would be glad to know which ones you are happy to hold. And yeah, thanks for watching this video, and I'll see you in the next one. Goodbye.